is to get a 9 to 5 job, save your money, work until you're 65 and finally retire when you're too old to enjoy it. Luckily, one of the businessmen I looked up to explained it in a slightly different way. He said the word retirement should be replaced with the word freedom, because once you reach a tipping point when you have enough money to stop working, you have true freedom. Every day you can do exactly what you want, no questions asked. Maybe that's relaxing on a beach, sipping a pina colada, or building businesses that change the world like Elon Musk. When you have the ability to retire, it's entirely up to you how you spend your time. So on that note, today we're going to discuss the plan I use to reach my retirement goal in my late 20s, starting from $0. This may be a little extreme for some people, but that's just me. I'm either 100% in or I'm not in at all. Obviously you can take this plan at your own pace, and who knows, maybe you'll even beat me. We'll get into all of this right after you hit that like button for the LTube algorithm, as it really helps push this video to more people. Also make sure to subscribe if you want to grow your wealth. Phase 1 is all about your freedom figure. This is the target that you have to reach in order to have full control of your life. This is something you should know even if you've got $0 in the bank. If you don't know your freedom figure, then it's a bit like being blindfolded in a running race. You can't see where you're going, so you may end up putting all your efforts in going in the wrong direction, or even tripping up and falling flat on your face. The reality is there are 3 types of people in this world. There are doers, dreamers and drifters, otherwise known as the 3 Ds. Actually, thinking about it, when I was at school they gave me a cap with D on it. They must have known I was a doer. So let's start off with drifters. They go through life living paycheck to paycheck without any financial aims. They don't really see the point of saving or investing money, as retirement feels like it's not something a young person needs to be thinking about. Dreamers do have financial goals, but they don't have any plans in place to actually achieve them. So they will forever just stay dreams. And finally, doers. They have financial goals, but most importantly have a plan to reach them. And that's where your freedom figure comes in. This is a very individual thing, and it all depends on how much you want to pay yourself each year when you retire. There's actually a great way to figure this out, and it's called the times 25 rule. So let's firstly assume you want to make $50,000 per year without working. Secondly, we would need to multiply 50,000 by 25, which gives us $1.25 million. The idea is that you're able to withdraw 4% of this per year without ever running out of money. And you guessed it, 4% of $1.25 million is $50,000. $1.25 million? How am I ever going to get that in 7 years? This video's a lie. I know this may sound tough, especially if you're starting from $0, but it is possible. No one said it's going to be easy, but with the right approach, it can be done. I mean, if I can do it, then so can you. In the early stages of your retirement plan, the way you think about money is crucial. It's all about getting the right mindset in place. The key is to prioritize building wealth over cash flow. This is because building wealth is about locking your money away in assets that increase in value, whereas cash flow gives you more money flowing into your pocket. Now this may sound great, but it can lead to a variety of problems such as lifestyle inflation and sky-high taxes. Cash flow is extremely important, but more so later in life once you start to unwind. This is why whenever I made some extra cash when I was younger, I made sure to reinvest the majority of it. Of course, I get it, sometimes it can feel really nice to secure some profit and lock it away in your bank account. It can give you a false sense of security knowing you've got all your money sat in your account for whenever you need it. But the reality is you often don't need as much money as you think. Forming a habit of reinvesting your cash flow is absolutely essential when it comes to building wealth as fast as possible and hitting your freedom figure. Phase 2 is laying the foundations. This is kind of like building a house. You need to lay a solid foundation to ensure your house doesn't crumble at the first sign of an earthquake. Unfortunately, 70% of millennials now live paycheck to paycheck, which means they're building their lives on an unstable base, just like building a house on quicksand. If you find that unbelievable, then this is even more shocking. 40% of Americans with an income greater than $100,000 a year are still living paycheck to paycheck. This just goes to show how important laying the foundations are, and even though it may seem simple, many people are failing at this phase. There are 4 stages I considered when I was in this phase during my early 20s. The first stage is paying off high interest debt. It's crucial to pay this off before you even consider investing your money, as high interest debt is holding you back. But saying this, it is very important to understand the difference between good debt and bad debt. Good debt is anything low interest that makes you money. For example, the mortgage on a rental property or low interest finance on a laptop to build an online business. Bad debt is high interest debt that doesn't make you any money. For example, shopping for clothes on buy it now, pay later, credit card debt, or even a typical bank loan. All of this debt needs paying off as soon as possible. I was in quite a lot of debt when I was 18, and in order to get out of it, I used the debt avalanche method, which involved making the minimum payments on all my high interest debt. Then I used any extra money to pay off the debt with the highest interest rate first, which was my store credit card at 32%. Crazy, I know. Signing up for that was a huge mistake, which I've talked about in some of my past videos. I then worked my way through the bad debt with the lowest interest rate, which was my car loan at around 15% at the time. Within a year, I'd managed to get everything paid off. The big lesson here is you can't invest to build wealth when being weighed down by bad debt. Stage 2 is putting aside an emergency fund. This is essential for your foundations, because if you start investing without an emergency fund, you might find a few months down the line you get into a spot of bother with an unexpected expense and no cash to pay for it. You will then have to pull your investments out to cover the expense, and then you'll miss out on the potential profits. Stage 3 is building a great credit score. A credit score is a bit like your resume. It follows you around in life, is regularly updated, and it helps lenders decide whether you're a worthy borrower. Having a good credit score is especially important if you ever want to get a loan in the future. For example, to buy your dream house. You just never know when you're going to need it. I should have actually started building my credit score a lot sooner than I did, because it's so easy to get started. All you need to do as soon as you turn 18 is get yourself a credit card. Start putting a few little expenses on it like gas, and pay that baby off in full at the end of each and every month. This way you pay no interest and prove to the lenders that you're a reliable borrower. Stage 4 is reducing your tax liability. Every dollar you earn has hidden costs. Of all the expenses, however, taxes can sting the most and take the biggest bite out of your money. No one likes the tax man. The good news is that tax efficient accounts can minimize how much tax you have to pay and maximize your savings. In my early 20s, my income was really starting to get eaten up by taxes, so I started looking for the best ways to save as much as possible. I then discovered if I opened up a retirement account, then I could save money I hadn't paid tax on. This is known as a 401k in the USA and a SIP in the UK. Of course, I will eventually have to pay tax on this, but as I'll be older, I'll be in a much lower tax bracket because I'll be earning less, so hence I should save quite a lot of money. But I didn't stop there. I opened another account that allowed me to save money that I'd pay tax on, but in the future I wouldn't have to pay tax on my capital gains, or in other words, all the money that the money generated. This is called a Roth IRA in the USA and an ISA in the UK. I firmly believe that everyone should set up both of these accounts as soon as possible, as I know it really reduced my tax burden. So once you've built up these solid foundations, it's time to start expanding. Phase 3 is building multiple income streams. I like to think about it like this. Imagine Spider-Man is you, the platform is your life, and the Skittle is your everyday job. If you get fired, guess what's happening? Now imagine this, Spider-Man is you, the platform's your life, but now you have multiple income streams. The stock market could crash, you could lose your job, or your side hustle could fail, but your life is supported by your other income streams. This makes it very hard for someone or something to come along and strike you out. A secure job is nowhere near as common as it once was, with the average person now working 12 jobs in a lifetime. There isn't one perfect solution for everyone, but something that has worked for me over the years is to pick side hustles that take advantage of my existing skills, as I don't have to learn something completely new. This will often end up being something you're passionate about as you develop the skills without even knowing it. Sometimes we can lean towards what will pay the most, but when looking to build long-term wealth, sustainability is important. So when waking up every morning, being passionate about your line of work is a great idea. As Richard Branson once told me over lunch, there is no greater thing you can do with your life and your work than follow your passions in a way that serves the world and you. Well, that's actually one of his most famous quotes, but he did say something along those lines. It was about 20 years ago, but one thing I do remember all the details about was the fantastic spaghetti bolognese he made for me. There are many different side hustles you can start, such as affiliate marketing, e-commerce, becoming an influencer, drop shipping, and even good old-fashioned window cleaning, bin cleaning, driveway cleaning, photography. The list goes on. I'm going to be gifting her $1,000 as well as arming her with the knowledge she needs to take the plunge as a complete beginner investor so she can start her journey to becoming rich and financially free. There's an old saying, be the person you needed when you were younger. And that got me thinking, sometimes with investing, the hardest part is just making a start. So if you're thinking about investing but find the whole process a bit daunting, or have started and want to find out some more, then this is the video for you. We're going to be going through everything step by step, from personal finances and taxes to investment strategies and actually setting up the core account. So make sure to watch to the end so you don't miss out on some great investment knowledge. We'll get started as soon as you hit that like button for the LTube algorithm. So Laura, what do you think when I say the word investing?
I get a little bit scared. I know it's the way to go. I'd love to learn a bit more about it and put my money in the best place, but if I'm honest, I don't really know much at all.
Well, it's normal to be a little bit scared, that's for sure. Judging by our analytics, not many girls are that into investing. Why do you think that is?
I'm not really sure why that is, but I'd like to learn a bit about it and show that it's possible for anyone to do, use it as a way to get rich.
Well, it's not all about getting rich, it's more about building your long-term wealth, but we'll get into that later.
What? I was here to get rich.
I'll tell you what I can do. How about this? I'm going to give you $1,000 to invest in anything you like.
That sounds really good, thank you. Let's get going.
I think we should. Let's dive in. People always say to me that they'll get good at managing their finances when they earn more money. But the truth is, anyone can go broke, even celebrities. You know, take Michael Jackson, for example. He was the king of pop with an estimated estate value of over $236 million when he died, but he left debts of over $400 million. So Laura, how would you say your finances are at the moment?
I'd say they're okay. I don't look into them too much. If I want to go out for a meal with my friends, I'll spend the money. But I do try to save about half of what I earn. I just don't really tend to track it.
Okay, well, tracking is a really good idea, and it's really easy nowadays to track your money using some of the apps that are available, and by tracking it you'll tend to spend less, so that's always good. But do you have any credit card debt or anything like that?
I don't. I spend my money on my credit card, but then I do pay it off every month.
That's great. You've been watching the videos, haven't you?
Yes.
It's always best if you use your credit card because it'll help you build your credit score. And if you pay it off at the end of every month, you're going to pay no interest whatsoever. And it's a win-win.
Oh, okay. So why is building your credit score so important?
Well, at some point in the future, you're going to probably want to borrow, be that for a house or for a business. You never know what you want to borrow for. And if you've got a good credit score, it's going to cost you a lot less in interest fees, and you're going to find it easier to borrow in the first place. So that's why it's so important to build a good credit score.
Oh, okay.
Taxes are something we should all care about, as at the end of the day, why would you want to give away more of your hard-earned money than you absolutely need to? When it comes to investing, in most cases, you are required to pay taxes on the profits that you make. This is called capital gains tax, and it's between 10 and 20% depending on your income. It's really important to minimize the tax you pay in these areas, so you're able to invest more for your future. And there are two really simple ways that you can take action. Now, the first is to open up a tax advantaged account, and the second is to start some sort of side hustle or business so you can write off all your expenses.
Why is a side hustle a good thing to have?
Well, it's all about when you pay your tax. If you get paid $100, for example, from work and you want to go out for a nice meal, well, it's all well and good, but you've already paid your tax, haven't you? So if that's 20%, $20 is already gone. Now, with a side hustle, you get your $100 and you want to go out for a meal, you can go out for a meal and you can then write that off. So when you come to pay your tax, you've got less money to pay your tax on, so you get taxed less.
Is that like bad?
No. It's 100% allowed because you're having a business dinner, you're talking business, and that business needs to be done over a dinner, so that is an allowed thing.
Yeah, that sounds really good. I have been thinking about doing a side hustle for a while now. I think that's always something I've wanted to do in the back of my mind, but I haven't actually got around to it. It's just deciding what I want to do. I've been thinking about a lot of things. Like I love seeing how people can do like Gymshark modelling on the side and being a bit of an influencer. That sounds amazing to me.
It's extremely important to research any investment before throwing all your money in. So Laura, have you heard of any before, and is there anything you've invested in?
I haven't invested in anything. Obviously I hear a lot about like cryptocurrency and stocks and shares, but it's all like a completely different world to me and I don't know anything about it. But I know that my money isn't very good sitting in my bank account. I want to do something with it.
Well, your money sitting in your bank account is actually losing you money, because you're probably earning about 0.1% interest per year, and that literally is nothing. And with inflation at more than that, around about 2 to 3% a year, that's actually losing value year on year.
I think the thing that I was looking at doing is buying a buy-to-let or something.
Okay, well, we can discuss that and run through the main investments which are good for beginners in order of least to most risky, so you can then decide what you want to do with that $1,000 I gave you.
Oh wow, okay. So the less risky it is,
Generally the less reward,
okay,
but the higher risk.
the better the reward.
Now, an index fund, simply put, is a basket of stocks. So instead of buying hundreds of different stocks separately and having to manage them all at once, you can buy into a simple low-cost index fund.
Do you get to choose what stocks they are?
No, you don't get to choose what stocks they are, but you can choose from a lot of different index funds.
Oh, okay. And does it matter what country you invest in?
Back when I was younger, I might have gone for an index fund based in the UK. But of course, nowadays, with the invention of the internet, of course, these companies in America, they are absolutely global. So they're always looking for more growth, be it in China, Australia, wherever it happens to be. So by investing in these American companies, you've got a global player there, haven't you? And they're passively managed as well. So there's not a manager there. It's all done automatically. That's why the costs are so low.
If I invest all my money in like a risky one, could I then lose it all? And it sounds like a silly question, but could I lose more? Could I go in debt or something?
Well, when you invest, your capital is always at risk. You have to remember that, but hopefully over the long term it'll be good. Now, unless you leverage your money, you can't actually lose more than you invest. So if you invested, for example, $100, the most you can lose is $100. However, if you leverage your money and bought things on margin, then of course you could lose more than you actually invested.
Okay, what does leveraging your money mean?
Well, leveraging your money is when you borrow money against your investment, or it's also known as margin. So for example, if you invested in a share, say you wanted to buy $100 worth of shares, but they were offering you 2.5 margin, you could actually have another $250 to go with yours. So you'd actually have an investment of $350. Of course, then you could lose that whole $350. Next is investing in yourself with a side hustle or further education. This is a low risk because the power is in your hands. Starting a side hustle has limitless potential returns, which is exactly what you want when you're trying to build wealth. So does this sound like an option to you?
Yeah, it sounds really good to me. I like the idea of investing in myself, not just getting my nails done and eyelashes done, obviously, but doing things like university, but it's kind of, you don't see the return straight away.
So how have you found that coming from university into the workplace?
So I feel like just with my degree didn't get me a job. You have to have other employability skills as well, and a lot of places often want a lot of experience and a lot of time in things that I haven't had time to do. So I definitely see the value in investing in yourself and enhancing your skills to make you more employable.
You've also thought about and mentioned side hustles as well, so of course you can invest into that.
I do love photography, a bit of videography. There was my mum's friend had a wedding and she didn't have a photographer, so I hopped in last minute and managed to do that, do a bit of video as well.
And did you do that as a paid job?
I did it for a bottle of gin. So,
So you're cheap then, that's what you're saying, aren't you?
No, I did it for free.
Well, sometimes that can be a really good investment as well. When you do a job for free, you're building up a portfolio. And again, quite often you need to do 3 or 4 jobs to build that portfolio up. So when you do want to charge people, you can show them exactly how good you are. Next up, we've got individual stocks, which are a medium risk. An individual stock is investing into one specific company. For example, Amazon would be considered an individual stock. The returns can be higher as it brings more exposure to one investment, but stocks can go either way. So I only invest in individual stocks with high conviction.
So a stock with high conviction, does that mean that it's going to give you a big return and that's why you invest in those ones?
Well, what it means is that you've done your homework on the individual stock. You've looked into the fundamental analysis of the company and you can see that it should give you a high return over the long term.
So fundamental analysis, that sounds a little bit complicated.
Well, actually it's not complicated at all, and you can find out all this information on Yahoo Finance, and you can pull up the company you're interested in and look at their balance sheets and things like that, and their profit and loss and where the company is going. And also it's important to look at the leadership of the company as well.
Okay.
Next we come to real estate, and I'm putting this as high risk for beginners, as real estate often requires a mortgage, which can mean taking on quite a substantial amount of debt. However, real estate is a great way to accelerate wealth and often performs really well during inflation.
I've always looked at Airbnb and I'd love to do that kind of thing.
If you're looking to do Airbnb, you've really got to make sure that that property can stand on its own without that platform. Because years ago, I set out to answer this question by creating a video where I invested $100 into 5 different things. Today, I'm going to compare the results from those 5 investments that you can make from your laptop and try to finally answer the question once and for all. We're going to be using this grid to judge each one in these categories. First up, learning curve. This is how long it takes to learn the ins and outs of each method. Ideally, we want this to be as short as possible. Next is passive income potential, which is how much money an investment can earn for you passively while you still own it, without needing to sell it. Then there's tax efficiency, which refers to the specific tax advantages or benefits available for each type of investment that can help you pay less tax. After that, we have risk level, which is about how likely you are to lose money and how much the investment's value might go up or down. And finally, we're looking at the results. This is where I'll reveal my percentage return over the last 4 years and exactly how much my $100 investment is now worth. Before we jump in, please remember, I'm not a financial advisor. I'm just sharing my own results and strategies that have worked for me over the years. Please also do your own research. Okay, first up is individual stocks. Individual stocks give you the chance to own a piece of a company you believe in. This can be really exciting because you're directly investing in businesses that you think will grow or succeed. For learning curve, I'm going to say this is high. If you want to be successful picking individual stocks, then it's not just a guessing game. You'll need to dig into the nitty-gritty of a company's fundamentals. This includes looking into the financials, who's leading the company, and how well known the brand is. When I invest in individual stocks, I look through income statements, balance sheets, and cash flow statements. So when I invest in a stock, I'm in it for the long haul, which means at least 2 to 10 years. A great way to learn how to do this is by using an investing app with a demo account, which lets you play around with fake money until you're confident with your strategies. For passive income potential, I'm going to say this is good. You see, when you own a stock, there are 2 ways you can make money. Firstly, if the price of the stock goes up during the time you own it, you can sell it for more than you paid. Secondly, you can receive dividends. Dividends are regular payments to shareholders. Not all stocks pay dividends, but if they do, this means you can receive money without ever selling your stock. This is essentially passive income. Now, for tax efficiency. This is great. If you use the right accounts, then you can reduce your tax burden. In the UK, these are called stocks and shares ISAs. You can set one up on most investing apps, and any profits you make are safe from taxes. In the USA, there's something similar called a Roth IRA. These accounts work like a shield, protecting your profits from the tax man. While there are different rules depending on where you live, the idea is the same. Please bear in mind that I'm not a tax advisor and you should do your own research as everyone's circumstances are different. So what's the risk? This is definitely high. Back in 1995, during the dot-com boom, I got lucky and picked a few great stocks. I sold them at the right time and made a lot of money in a short period. But when the bubble burst, some of the other companies I'd invested in, ones that cost me very little, went out of business completely, even though I ended up making money overall. It just shows how risky investing in individual stocks can be, especially if you put all your money into just a few companies. If they fail, you could lose everything. So let's look at how much my $100 investment is now worth. Let me refresh your memory. Here's what I invested in. So I'm going to throw a dart at the board, and as you can see, I've randomly selected 20 different stocks, and wherever the dart lands, that's what I'm going to invest in. Now I've just got to put on a blindfold. Okay, here we go.
Oh, you hit it.
Right, let's see what we got. And we've gone into Samsung. That investment is now worth $67.66. But don't forget my dividends. Over the 4 years, I made 10 cents. So that leaves me with a total of $67.76. That's a negative 32.34% return. This example perfectly shows how hit or miss individual stock investing really is. That dart could have just as easily landed on Apple, Microsoft or Nvidia. So let's have a look at how much I would have made if that dart had landed a bit differently. A $100 investment in Apple 4 years ago would now be worth $170. The same investment in Microsoft would be $188. And, drum roll please, Nvidia would be worth $908. Those stocks have boomed in recent years, and luckily I have some of those in my personal portfolio. But this just goes to show you can't just leave individual stock investing down to luck. You have to be strategic with your stock picks, and even then the market is unpredictable. If you want to try this out, just download Trading 212. It's a great app for beginner investors because it lets you use a demo account to practice trading with fake money. This way you can learn how it all works without risking any real cash, just like I mentioned earlier. It also lets you set up a stocks and shares ISA if you're in the UK, which protects your investment returns from taxes. But again, I'm not a tax advisor, so please do your own research as everyone's situation is unique. Trading 212 also lets you buy fractional shares, which means you don't have to buy a whole stock. That's how I was able to own just 0.07 of a Samsung stock, instead of having to buy an entire share. As I was going to mention Trading 212 anyway, I reached out to see if they'd be interested in sponsoring this portion of the video. They agreed and are offering a free fractional share worth up to £100 to anyone that uses the code Tilbury when they create an account. Plus you can get more free shares by inviting your friends. Both of you will get a free share as long as they fund their account. I'll leave the link in the description if you're interested. Second is a real estate investment trust, otherwise known as a REIT. I know this one sounds pretty complicated, but it's actually quite cool. Imagine your friend collects $100 from 3,000 people, giving him $300,000. He then uses that money to buy a property, rents it out and shares the rental income with all 3,000 people who helped him buy it. That's a simple way to explain a REIT. It allows anyone to invest in properties without needing to buy one themselves. Think of it like you own the front door, someone else owns a window and a few others own the bricks, which means together everyone owns the entire property and shares in the profits. For learning curve, I'm going to say it's moderate. And that's because getting started with REITs is much easier than buying physical property. It's not like you need a huge down payment or a mortgage, and there's no need to deal with agents or solicitors. However, you do need to understand how REITs work. They own things like offices, shopping centres, apartments, hotels and much more, and they get their income through rent. For passive income potential, I'm going to say this is great. REITs are well known for paying high dividends. This is because the law says they have to pass on at least 90% of all their profits to investors. So as long as the REIT is doing well and its properties are rented out, you can earn a steady stream of passive income. Most businesses sign long-term leases on their commercial properties. Therefore, most of the time, income is pretty stable and reliable. But of course, just keep in mind that your earnings depend on the REIT you pick and the types of properties it owns. For tax efficiency, I'm going to put this down as great. This is because in many countries, REITs offer great tax benefits. For example, in the UK, you can hold REITs in a stocks and shares ISA, which means you don't have to pay taxes on your profits or dividends. In terms of risk, I'd have to say this is medium. REITs are generally less risky than buying a single property because they invest in multiple properties, spreading out the risk. However, they're not risk-free. If the real estate market takes a downturn, or if the REIT struggles to keep its properties rented, you might see both a drop in dividends and the value of the investment. So what's my investment worth now? Let's flash back to me making the investment 4 years ago. As I'm in the UK, I'm going to use the Trading 212 website to put $100 into a similar REIT. Ready for the moment of truth? Looking at my investment now, I can see it's worth $98.59. So that's a small loss of 1.41%. This shows that even though REITs are normally more stable than individual stocks, they're not guaranteed to perform well. My REIT likely underperformed because it invested in commercial real estate, which struggled during the pandemic. But that's not the end of the world, as I made $11.93 back in dividends, meaning I'm actually $10.52 up. So that's 10.52% up. Third is cryptocurrency. Imagine a form of digital money that isn't controlled by any government or bank. That's what cryptocurrencies like Bitcoin and Ethereum are. These currencies run on the blockchain technology, which makes them secure, transparent, and almost impossible to counterfeit. Cryptocurrencies have created massive wealth for some people, with Bitcoin being the best performing asset of the last decade. But on the flip side, it's highly volatile and people have also lost fortunes. That's why I describe crypto as part investment and part speculation, and not for the faint-hearted. For learning curve, I'm going to say it's moderate. Crypto might sound complicated, but I'll break it down for you. First, you'll need a wallet. This is where you store your crypto. Think of it like a digital piggy bank, and there are different types. First are online wallets. These are easy to use, but you'll need to protect them with very strong passwords. Second are offline wallets, like hardware wallets. These are the safest because they're not connected to the internet. Next, you'll need to pick an exchange to buy and sell your crypto. Some popular ones are Coinbase and Binance. These platforms make it simple to trade, but make sure to choose a trustworthy exchange to avoid any issues. Then there's tokenomics. This just means understanding how the supply and demand of a coin works. For example, Bitcoin has a limited supply, which is why it's often called digital gold. For passive income potential, I'm going to also say this is moderate. Unlike stocks or REITs, crypto doesn't pay dividends, but there are ways to earn passive income. The first is called staking. This is when you lock up your crypto like Ethereum to help the system work and process transactions. In return, you get paid rewards, kind of like earning points for helping out. The second is yield farming. This is when you lend your crypto out to others and earn interest on it, similar to how a bank pays you interest when you save money with them. These methods can generate decent returns, but they do come with higher risks. If the coin's value drops or the platform you're using gets hacked, your income could disappear along with your crypto. That's why I personally don't mess with any of this and just hold mine on a Ledger wallet. For tax efficiency, I'm going to have to say this one is poor. Taxes are a tricky part of crypto investing. In many countries, even swapping one cryptocurrency for another counts as a taxable event. And if you earn staking rewards, those are also taxed as income. You also can't hold crypto in tax-advantaged accounts like ISAs or Roth IRAs, which makes it less tax efficient than stocks or REITs. In terms of risk, I'd have to say it's very high. Crypto is one of the most volatile investments out there. Prices can soar 1,000% in a year, but they can also crash just as fast. Personally, I just invest in Bitcoin and Ethereum as they are more established and often referred to as blue chip cryptocurrencies. Smaller altcoins can be far more risky. You've also got to be cautious of scams. Since crypto isn't regulated, if someone hacks your wallet or tricks you into sending your coins, there's no way to get them back. So keeping your crypto safe is just as important as learning how to invest in it. So what's my investment worth now? Let's rewind to when I made this investment 4 years ago. So I'm going to jump onto the most popular Bitcoin app, which is called Coinbase, and invest my $100 in Bitcoin and forget about it. Ready for the reveal? The $100 I invested in Bitcoin is now worth $652.24. That's a return of 552.24%. Now, I know what you're thinking. That's insane, and it is. But I have to stress that this kind of growth is not typical. Bitcoin has been the best performing asset of the last decade, but most cryptocurrencies don't see these kinds of returns. Many lose their value entirely. In my opinion, crypto is exciting and the technology behind it has the potential to transform industries. However, it's not for everyone. It's highly volatile, speculative, and requires a strong stomach to handle the wild price swings. Just remember, crypto is all about high risk and high reward. So if you're going to dive in, make sure you're doing your research and investing wisely. Fourth is gold. This is one of the oldest and most trusted ways to store and protect wealth. Gold is often called a safe haven because it's a great way to protect your wealth during uncertain times, like when inflation is rising or the economy is struggling. For learning curve, I'm going to have to say it's low. Learning how to invest in gold is pretty simple. You have two main options. First, physical gold. This includes gold bars and coins. Many people also think you can buy gold jewelry as investments, but you'll often pay more than the gold is actually worth because sellers add a markup for their craftsmanship. For this reason, I personally stick to gold coins. Just bear in mind, if you pick this option, then you'll have to store it somewhere safe. Second is gold ETFs. These are funds that let you invest in gold without physically owning it. For example, in the UK, you can use Trading 212 to buy shares in something like the iShares Physical Gold ETF. It's quick, easy, and you can buy or sell it with just a few clicks. Passive income potential is absolutely zero. Unlike stocks, REITs, or crypto, gold doesn't pay any passive income. It's not an income generating asset. It's purely a store of value. For tax efficiency, I'm going to put this as good. If you buy physical gold like gold coins or bars, the tax rules can be a little tricky. For example, in some countries, certain gold coins like the UK's Gold Britannias are considered legal tender, which means you don't pay capital gains tax when you sell them. However, this doesn't apply to all gold coins or bars, so you'll need to check the specific rules in your country. For gold ETFs, they're generally more straightforward. In countries like the UK, you can hold them in a stocks and shares ISA, which makes any profits completely tax-free. Interestingly, physical gold has another unique advantage. It can be used to transport wealth across borders discreetly. That said, this approach comes with risk, such as theft or legal restrictions on transporting large amounts of gold across borders. While it's not something I'd necessarily recommend, it's worth mentioning as a unique aspect of owning physical gold. In terms of risk, 99.9% of men on the planet. But the craziest thing about all of this is I let him take control of the day, so I didn't know what to expect. Good morning.
How are you?
I'm very well, how are you?
I'm very well. Akeem.
Thank you very much.
No problem.
I can't lie, don't know what the day's holding, as we've said. We're just in one of the best places on this planet. I'm really hoping that we can show how Iman's come from nothing and grown his wealth to where he is today. He's done it in an amazingly short amount of time. That's the hard bit to comprehend, is the time scale. He's 23 years old and worth around about 80 plus million. It's quite amazing as we drive along the Palm. When you look at it, you wouldn't actually think that each of these branches was as long as it is, and I'm guessing this is going to be about a mile long. Yeah, it's quite surprising. How are you, sir?
Apologies, the place is a bit of a mess.
I always use that line, it looks gorgeous. That's stunning, isn't it? Absolutely stunning. Yeah, how long have you owned this property?
So this place I'm renting at the moment.
Yeah.
Finding a place on the Palm is very difficult because
It looks sold out, doesn't it?
everything's very cheap here.
Really?
So you'll get like a $10 million house and yeah, everything's just built so poorly. That house sold I think for $35 million. That one right there is $100 mil. But that one at the end is just crazy. The rent on this is like $50,000 a month.
And are you looking to make this your base, Dubai now?
Yeah, 100%.
That and South Africa?
Yeah, Cape Town. Cape
Yeah.
Town's the best, I'm telling you.
Now, I knew that E-Man was doing well, but having a villa on the Palm, well, that's next level. It's one of the most desirable places to live in the world, and he's achieved all of this from very humble beginnings. He's living the life that many people dream about. I was intrigued to know if he still wanted more. You said it was about $50,000 a month to rent.
Yeah.
Do you begrudge that a little bit?
I mean, it is what it is because I'm still only, 6-7 years into having a business. If you're always on a trajectory up, then you always know that you're going to get to a point where you can upgrade. Like I always tell people, listen, would you still buy that same house if you had $300 million? And they're like, no, I'd buy this house. That's why, for example, it doesn't make sense to spend $10 million on a penthouse in Dubai because there's always going to be that new penthouse that's nicer. I don't know. I was looking at Phantom.
Yeah.
So I really wanted to get Phantom, but they're 18 months at the moment to get them spec'd out. So I was looking at what was on the market. They're all very a little bit too old manny. Yeah.
You get something like a Lamborghini Urus or something
Nah,
like that.
I hate those cars.
Really?
I mean, I was thinking about getting a wagon as well because that's my favorite car ever. And then I'm thinking about also getting a Maybach. But once again, we're still here only half the year. We travel in and out quite a lot. Even the house, I've had it for 5 months. I've been there for 3 weeks, 2 weeks, something like that.
Most people would be over the moon to be living in a multi-million-dollar villa on the Palm, but to E-Man, this isn't even scratching the surface of his ambition. He thinks he's destined for more. Maybe he has some kind of superiority complex. So would you walk around with that particularly nice Richard Mille on in London?
Axe, when I walk around with an RM in London.
We just have to go through things and talk about where we're going and plan it. And if it makes sense, then we can wear a watch. If it don't, then we won't wear a watch.
Yeah.
Simple as that.
So we've arrived somewhere.
Yeah, we got a little gift. I would have given it to you at the house, but there's a little bit of there's a few options that you can choose from. Just for valet up front here. Simon, I'll message you maybe 90 minutes. Yeah, I'll let you know. That's the other thing. People come to Dubai for shopping.
Yeah.
Dubai is the worst place on earth for shopping. For some people, it's their heaven, but for me, European shopping, London shopping is the best in the world.
Because obviously a lot of the high-profile stores actually have queues outside, don't they?
Yeah, no, that's why
You don't need to queue.
No. I mean, that sounds bad. Sometimes it depends. It depends on the brand.
E-Man said he had a surprise for me, and knowing him, it was going to be special. I'm super excited for you to see the rest of this video, but first, I wanted to share something with you that I think could really help you with investing in the long term. Have you heard of Lightyear? It's an investment app that's on a mission to help investors across Europe, and they're kindly sponsoring today's video. One of the things I love about Lightyear is that it's so user-friendly. Even if you're new to investing, you'll find a wealth of data and information on the brands and funds you want to invest in. Another great thing about Lightyear is that it gives you access to over 3,000 stocks and ETFs from all over the world. Lightyear is now available in 20 plus countries throughout Europe. So if you're watching this from a country that spends the pound or euro, it's available to you right now. And if you sign up with my code Tilbury and make your first trade, Lightyear will send you a $10 fractional share of your choice. But let me remind you, investing always carries a risk, and the value of any investment can decrease as well as increase. So be sure to invest wisely and do your research. Now let's get back to this video about E-Man. Walking through the mall, I had absolutely no idea where we were going, but E-Man seemed to have a plan.
Because you guys have been traveling so much, I thought I'd get you a little gift. I'm just here to pick up 3 large cabins. I believe my assistant should have called in. I saw you guys traveling a lot, so I thought, might as well.
My pleasure very much.
God, he has the largest hands, I swear to God. I feel like tiny. Listen, you guys are going to have the best luggage in the podcast game. Whoever's bag I'm sitting
It's
on.
like a trunky, isn't it?
No, honestly, I just roll around to roll around the airport. It's so fun. You're paying half for the suitcase, half for the seat.
I've seen him giving away expensive gifts many times on social media, from watches to cold hard cash, but I was still taken aback with his manners and generosity.
When he gives you something, he hits the spot every time. It's unbelievable.
However, one thing we can't overlook is how much this helps to cultivate his wealthy and kind-hearted image on social media, which is obviously great for business. But are his intentions pure or purely self-serving?
I have a lot of cash flow coming in, and I have a lot of resale value and equity in my software companies, and that just went crazy last year. I just made an offer, actually. I made an offer for 2.9 cash on a place in Chelsea, but we'll see.
E-Man said we're off to somewhere really hot, so I went for a quick outfit change, jumped in the car, and off we went.
Without being rude, and I hope this isn't rude, obviously you have got an actual dad. He's still alive somewhere, I assume. Do you know him?
Not personally, no. He was alcoholic abusive, so my mom left him when she was pregnant, because then he wasn't just affecting one person, he was affecting two. For me, it would be weirder, the idea of having a dad than not having a dad. And what I always say is, it's like, for the people that have a father, it's sure they have a dad, but it doesn't mean that they're a good role model.
By having a father, some of the things he taught me, I would say, have held me back through my life. My dad was very much, you shouldn't borrow, because that was taught from the generations before him, from probably World War II and all the various things that went on.
It can be a massive advantage, or it can be a massive disadvantage. If you have a father, you might take on 20%, you might take on 50%, you might take on 80% of their beliefs, and if their beliefs are wrong, then that puts you in a bit of a sticky situation. So yeah, for me, it's of course it's a disadvantage growing up in a single parent household, but you know,
But you found advantages within that.
Every once in a while it can work.
What would you put down your accelerated growth to?
I think it's just a lot of life circumstance. I think a lot of it is genetics as well, like just stuff that's natural inbuilt. I think there's a lot of people in my situation who just, no matter what, would not have the same level of stress tolerance, and also wouldn't keep pushing. Becoming successful at whatever you do is, sure, it's difficult, but I think staying in that position is really where legends are made, and that's really where, you know, you earn your stripes and you earn that respect. So I think a lot of people can make it. I don't know a lot of people can stay in that same position and keep that same level of intensity. What I achieved, you wouldn't want to, because you're sacrificing so much. You're basically sacrificing your sanity.
E-Man says he's genetically gifted with a higher stress tolerance than most, but he is still young, and I can't help but be concerned about the long-term effects of living under these conditions. In my youth, I thought I was invincible too, and after working myself to the bone, I had a serious health scare that shocked me back to reality. I wonder if E-Man is heading down a similar path.
I'd never call myself British though.
No?
Nah.
So what do you call yourself?
Confused.
Before I knew it, we'd arrived at our early enough to become a millionaire. On that note, about a month ago, I gave Laura $1,000 to invest however she liked. She'd never done anything like this before, and you guys loved it so much that you've been asking for an update. So, here it is! Firstly, we discussed how to overcome the fear of investing, because it's all about getting started.
Not really for me. I don't really know much about it. Bit risky.
Next, we'll be revealing how much money she made.
So I put £240 in, and it's now worth.
And finally, unpacking her plans for the future.
Not many girls, I feel like, are investing into it. I kind of like to be there and go, nope, we can do it as well.
Watching this video all the way through will put you in the best position when it comes to making money from investing, as we're going to be showcasing real results with realistic amounts of money. So make sure to smash that thumbs up button for the LTube algorithm, and we'll get started straight away. Hi Laura, how are you?
Hi, good, thank you. Thanks for having me back.
Yeah, you're more than welcome. You know what, it's been a couple of months since we started this investing journey.
That's gone so quickly.
It certainly has. So what I really want to know is, what did you actually think about investing, and what are your thoughts on it?
So before I kind of started, I was a bit apprehensive about it, didn't know much about it at all. But the best way to start learning more and more and become really invested in the whole investment process is to actually start. So that was great that you gave me the ability to start doing that. I think it's just the unknown, and the whole link, it kind of seems a bit like gambling. I think you have to just kind of build the trust in it and learn for yourself and know that if you invest and you lose some, then that's you can live with that.
So it's more of a misunderstanding, isn't it? And probably because it's not been taught in schools to give people the confidence to go ahead and to do it. And what about your friends as well? Because that's another key thing, isn't it? So have you spoken to any of your friends about the investing?
I have a little bit. I know I mainly spoke to my brother about it, and I was trying to get him to sign up for a free share, and then it's just the signing up process for him.
Yeah.
So once he signed up, I think it'll be fine. And I was going, look, Mark and Curtis do this, it's absolutely fine. But yeah, it's just building that trust. And I think as he sees whether my investments have done well and things like that, I think he's just keeping a little sneaky eye on mine, and then he might do it himself as well.
Yeah, I think that's always a bit of a shame to look at it that way, from the way he's looking at your investments and only going to go into them if they go up. I think people need to look at them as a very long-term thing that you're putting money into over a period of time. So maybe you can give them a nudge and say, look, don't wait, because there's no time in the market. It's time in the market that you need. You've got to stay in there.
You've also actually just reminded me of something he said the other day. He said whether he was a bit too late to the Tesla. So I don't know whether, because there's so many stories about people having shares and coins and things, and then it goes up exponentially, and then they wonder whether it's going to plateau or go down from here.
Well, that's the whole thing about time in the market. Nobody really knows where the market's going to physically go. Now, if you take Tesla as a prime example, if I said to you Tesla's going to be $2,500 this time next year, would it be too late to invest? No, exactly. So, we don't know where it's going to go, and trying to time that market will mean you'll never actually get in, because the excuse to get in will be, oh, the market's too high, and the other excuse will be, oh, it's falling, I don't want to get in while it's falling. So there's always an excuse not to invest, and that generally stems around people trying to time the market. So I think you might need to have a word with him.
I will. I feel bad now. Sorry, Michael.
So you mentioned a free stock there, and that's a really good way to get started. And we've partnered up with Public.com in the USA, who are actually offering you a free stock worth all the way up to $1,000 when you sign up. And if you're in the UK, you can sign up to Free Trade, and they're offering a free stock worth all the way up to £200. It's basically free money, and I'll leave the links in the description below if you're interested in getting started. Let's talk about stocks. Can you remind us all, because we all want to know, what stocks you bought?
Yes, so I bought Tesla and an S&P 500.
Okay, so how are they performing?
They're actually doing really well. I feel like there's been a little boom in the market at the moment. So,
okay, well, remind us how much you invested first of all in each stock, and then we can see where it's gone from there.
Okay, so in Tesla, I put £200, and it's now worth £341.82p.
Wow.
So the gain is £141.82, which is in dollars 190.
That is unbelievable, isn't it?
I know, it's crazy.
And how much work did you actually need to do to generate that money?
Absolutely nothing, apart from checking every now and then, because I got so excited, and it goes up and down, and then it just kind of went up.
And that's really because they've come to an agreement with Hertz to supply them 100,000 electric vehicles, and that's the equivalent of a $4.2 billion deal. Not only that, in Europe over the last 3 months, Tesla Model 3 is the best selling car. Not the best selling electric car, the best selling car, period. So, what great news when you've got shares in Tesla.
Yeah, definitely. I can kind of tell as I'm driving on the roads, I see more and more Teslas pop up everywhere. So,
well, it used to be a rare sight, didn't it? I remember when I first suggested to Curtis that we get a Tesla, that it was like, well, no one's driving them. You never see any of them about. They can't be that popular. And we really did look, you only saw them now and again. Now they are literally everywhere, aren't they? And they've got a good charging network. That's all I can say. That certainly helps the Tesla brand, because you can charge up quickly, and it just works. We're really happy with ours, and it seems that it's the growing thing.
Yeah, definitely. And the kind of move in the future to all electric cars, I know that's kind of been pushed back again recently, but yeah.
And that gain is in a 2-month period as well. $2 on a sweet treat and $1.40 on unwanted subscriptions every day, then that's the same as spending $10,000 every single year. This is the reality for most people. As soon as they get paid, the money just seems to disappear. And that's because they don't have a paycheck routine. This is so important because being careful with my money in my late teens and early 20s was the thing that enabled me to become the first millionaire in my family. So in this video, I'm going to be talking about the 5 things I did every time I got paid so you can apply them too and hopefully achieve even better results. This will not only help you save extra money, but also build your wealth. And the beauty of all of this, you won't have to work any harder than you currently do. Right, let's imagine you've just been paid. The first thing you should do is separate your wants and needs. Believe it or not, this is one of the hardest things for people, even though it sounds simple. Especially nowadays, most people are used to such a high standard of living that they find it hard to cut down on their little pleasures. These might seem small and insignificant, but in the long term, these little pleasures are actually robbing you of your financial freedom. Even if you think this doesn't apply to you, I still want you to do this exercise. You might surprise yourself with the things you uncover that are draining your money. So, grab a pen and a piece of paper and split it into 2 columns. So you've got wants and needs. Now get some of your recent bank statements. It's probably best to get around 6 months worth and start highlighting all the things you repeatedly spend money on every month. For now, let's ignore the one-off purchases. Unless you're repeatedly buying a lot of random stuff, then this shouldn't be a huge issue. I'm more interested in focusing on those little purchases that stack up over time. Once you finish doing that, it's time to sort them into the correct column. Needs should be things like rent, insurance, bills, and other utilities. The rule is, if you can survive without them, then it's not a need. Your wants should be all the fun stuff like nights out, restaurants, bowling, golf, whatever floats your boat. Once you've completed both sides, then it's time to figure out how much each column costs per month. Let's start with needs. Let's say your rent, insurance, bills, and utilities add up to $1,200 a month. This is the bare minimum you need to get by each month, also known as your financial baseline. Once you know your baseline, subtract it from your monthly income to see how much you've got left over. Many people say your financial baseline should be under 50% of your total income, but to be completely honest with you, I think it should be closer to 25%. Now, don't treat this needs column as something you can't change, as there are things you can do to bring down the costs, but still meet all your basic needs. You might need a car, for example, but it's worth asking yourself, do you need a car that costs so much? The same goes for where you live. Some apartments can be mega expensive nowadays, especially in city locations, but this is where you need to start weighing things up. Would it be cheaper to commute each day? Probably. So consider moving somewhere that you can actually afford. I mean, if you can share a house for a year to save up some money that you can invest, which could help you buy your dream home, why wouldn't you? Look, maybe you don't want to cut back anymore, and that's completely fine, but it's worth seeing if there are some areas you can save money without impacting the quality of your life too much. If you can't reduce your bills, you're going to have to increase your income, which is completely possible by getting a promotion or starting a side hustle. Remember, your earning potential is always higher than your saving potential. I know making your needs cost less than 25% of your paycheck might sound a bit impossible right now, and how it might sound coming from a boomer millionaire, but I really do understand what it's like to earn very little. I didn't grow up wealthy, and it took me a considerable amount of time to boost my income to hit a financial baseline of 25% of my salary. But trust me, if I can do it, so can you, especially with all the online side hustle opportunities you can take advantage of. So don't think I'm just saying if you're poor then just earn more money. I understand there is much more to it than that. Just treat my 25% rule as a target to work towards. Now for the wants column. Add them all up and subtract them from your wage. Ideally, this should be below 25% of your paycheck because we need a decent amount of money for the next steps to start getting you ahead. The second place your money should be going is into a high interest savings account. So in an ideal world, you'll have about 50% of your paycheck left at this point. Most people would just tell you to save all of it. However, that's not going to help you build your wealth. Instead, I recommend sending 20% into a high interest savings account. It's best to use a different bank to your everyday account, as otherwise it's just too tempting to spend it. Some great options are Chase in the UK and Ally Bank in America. I say high interest, but that's all dependent on when you're watching this video. Currently, my savings account gets around 4% interest a year, which is definitely better than my current account, which is around 0.05%. I know some of you are already commenting, I know a bank account with 7% interest. Don't get me wrong, this is great as long as you don't have to lock away your money for a set amount of time and the bank is reliable. The whole purpose of this savings account is to act as a safety net that you can withdraw money from in an emergency. It's not there to make you money. So locking it away for a set amount of time actually completely goes against the point of doing this. I can't even begin to tell you how important it is to have a safety net. Now, I know you've probably heard this 1,000 times, but that's because it's great advice. Life isn't smooth sailing, and at some point, an emergency will come your way. This pot of gold will always be there for you when you need it. So say you got sick and couldn't work, or the car broke down, you'd be able to cope with this situation just fine. I must reiterate that this money is only to be used in serious situations and not just something to dip into when you're running low and want that extra pint of beer. It's just shocking to me, as of May 2023, 1 in 5 Americans have no emergency fund at all. So if something went wrong, which it will, they have no way of coping with it and would most likely have to take out a loan, which most of the time ends up with them paying crazy interest rates and falling even further behind. So how much should your emergency fund be? Well, I'd say your emergency fund should be 3 to 5 months of your baseline figure that we discussed earlier. Even better if you can stretch that to 6 months. So once you've put by 20% of your paycheck for enough months to hit this figure, then you can allocate more money to the next places we're going to be talking about. In an ideal world, you should have 30% of your paycheck left by this point. So where should you put the rest? Well, next is the only place you'll ever get a guaranteed return on investment. Let me explain. Normally, if someone tells you they can make you a guaranteed profit, then I'd say run away as fast as you can. It's normally the grifters feeding people this garbage. However, in this instance, it's 100% true, as I'm talking about paying down your high interest debt. I mean, why bother investing in stocks for a possible 8 to 10% return when you can have a guaranteed 25% return by paying off the debt that's constantly eating into your wealth every single day? It's kind of like someone asking you what the best foods are to eat and exercise routines to follow, while knowingly having a parasite inside their body sucking away all the nutrients. Of course, a doctor's main priority is getting rid of that parasite, as it's pretty much guaranteed that you'll feel better. So if you have high interest debt, then I'd recommend putting the remaining 30% of your paycheck towards paying it off. There are 2 really common methods that you can use to pay down your debts. The first way is the avalanche method, and this is the most logical way to tackle debt because you pay off the debt with the highest interest rate first. So let's see how this will work in the real world. Imagine you've got 3 different debts. Debt A is for your credit card and it's $5,000 with an interest rate of 20%. Debt B is a loan from your family of $1,500 with no interest rate. And Debt C is a car loan for $2,500 at an interest rate of 15%. If you decide to pay $500 per month towards your debts using the avalanche method, this would firstly all go towards Debt A until it's paid off, as it's the highest interest rate. This would take around 13 months and you'll end up paying $515.22 of interest. After this, your $500 payments would go into Debt C and it would take a further 5 months to pay off that, which would include $98.13 of interest. Then it would finally be time to attack Debt B, as your family are probably getting a bit impatient for their money. This would take 3 months and obviously you'd pay no interest. So with the avalanche method, you'd be debt free in 21 months and pay approximately $613 in interest. The second option is the snowball method. This is the psychological way to tackle debt because you pay off the smallest debts first. The thinking behind this is it makes you feel like you're making faster progress. So you'd pay Debt B first, followed by debt C, and then finally debt A. However, if you use this method, it would take you around 23 months and cost approximately $1,700 in interest payments. That's 2 months and over $1,000 more than using the avalanche method. So if you can stick to the logical approach, it'll be worth it in the long run. Once you finish building your safety net and paid off any high interest debts, you can put that combined 50% towards growing your wealth. That's why place number 4 is a tax advantage investing account. When you get your paycheck, income tax gets taken out of it right away. Go to the store and buy something and you'll run into sales tax. If you own a property, you'll pay property taxes every year. Even when you invest and eventually make a profit, you'll be hit with capital gains tax. Unfortunately, I can't help you with most of them, but luckily there's a legal way to avoid paying capital gains tax on your investments. If you're in the UK, you're going to want to get yourself a stocks and shares ISA, and if you're in the US, you should get the equivalent, which is a Roth IRA. They both have different rules, which I've discussed in past videos, but the bottom line is, both these accounts allow you to invest without worrying about taxes. If I were you, I'd put 35 to 40% of your excess money into one of these accounts and invest it in a low-cost index fund like the S&P 500. Over the years, this has made me on average around about 8 to 10% tax-free per year. Of course, I'm not a financial advisor and this shouldn't be taken as financial advice. Stocks can go down as well as up, so it's important to understand the risks involved. Just imagine if you invested $250 per month, then assuming an 8% average annual return, you'll have 1.3 million in 45 years' time, completely tax-free. Feel free to head over to the Compound Interest Calculator website to do the maths for yourself. I understand it's a pretty slow way to build wealth. However, if you're consistent, then historically it's proven a very successful strategy. One of my favorite investing platforms is Trading 212, as they offer a stocks and shares ISA. Since I was planning to talk about their app anyway, I reached out to them to see if they'd be interested in sponsoring this portion of the video. They agreed and are also offering a free fraction